Hi, everyone. Welcome to today's webinar. My name is Fawad Razakzada, market analyst with Think Markets. Joining me in the room will be my colleague, Victor, who is having some technical issues at the moment, but he said he's trying to sort out the problem and try to join us in a bit if he can. Now, today I'll be presenting the non-farm payrolls webinar, and I hope that you will all learn something from us. So the webinar is divided into two parts. First, we will discuss some non-farm payrolls indicators that have been released this week. And we will use those data to try and come up with a rough idea of how the headline jobs number may look like and how this in turn might impact the markets. The second part of the webinar will be about technical analysis of a few major currency pairs, gold indices, in order to provide you some actionable trade ideas after the jobs report, the jobs report is published. So yeah, please don't forget to ask me questions as well. This webinar is supposed to be very interactive. I would appreciate if you have any questions on any tradable markets with Think Markets. Maybe something related to the non-farm payrolls would be ideal in this webinar rather than the other webinar that we do every week on Tuesdays at 11:30 London time, the live market analysis webinar. But in this particular webinar, let's keep the focus on the non-farm payrolls, okay? Now, before I begin, please read through the risk warning. I'm going to read the first paragraph with you, okay? So these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So this webinar happens every first Friday of the month. That is when the US jobs report is published. And I've already discussed the agenda, and we will talk about the markets like reaction, and also we'll have a Q&A session at the end of the webinar. But if you have questions during the webinar, please don't hesitate to ask me as well. So the non-farm payrolls report is or has traditionally been one of the most eagerly anticipated macro events for the markets. This is because one of the Fed's mandates is to maximize employment, the other being to keep inflation around the 2% average target. Now, when employment is strong and the economy is doing well, and all else is being equal, the Fed is expected to maintain expansionary monetary policy stance. That is, it would be raising interest rates so that inflation does not overcook. But when the economy is not doing so well and lots of people have lost their jobs, such as during this pandemic, the Fed will be doing the opposite. That is, it will be lowering interest rates as it has and provide other forms of monetary support like buying assets like government bonds in order to lower longer-term yields or longer-term interest rates to encourage households and businesses to spend more and drive investors into the racier equity markets. Now, in recent months, the economic data in the US has kind of taken a back seat. Investors have become more concerned about what governments and central banks will do in response to the coronavirus situation, rather than worrying too much about short-term changes in economic data. But with the COVID vaccines being rolled out now, these monthly job reports will once again become important as the market tries to figure out what the Fed is going to do next. So I think it's, people will be watching incoming US data very closely. And obviously the jobs report is major, right, insofar as the Fed's policy is concerned. So it will be important insofar as the markets are concerned. Now, this is what the markets expect. The headline jobs report is expected to print 62,000. Now, last month, we had a very disappointing figure of a 140,000 loss. So the first question is, Have jobs rebounded? And if so, can they beat expectations? The unemployment rate is expected to come in unchanged at 6.7%. And a measure of inflation, which is the average hourly earnings, is expected to have risen by 0.3% month over month in December, compared to a rise of 0.8% the month before, which was a sharp rise, I have to say, in the month before, in November. But this time, the average hourly earnings is expected to come in at 0.3%. Okay, so those are the key numbers to watch out for. If you see numbers, especially on the headline front, if you get a number well above 62,000, then that should be positive for the markets. Now, I'll talk more about that in a minute. But before, I kind of use 3 pre-NFP indicators, if you like, to determine how strong or otherwise the job report is likely to be. Now, among them, we have the ADP private sector payrolls report, which is released on a Wednesday. We also have the ISM manufacturing and services PMI, the employment components of those, released on Monday and Thursday, respectively, on the week that the official jobs report is released. Now, going through these, the ISM manufacturing employment component edged up by 0.9 points last month. So not a great increase, but a small rise nonetheless, which is positive. The ISM services employment component was the key one for me. It came in 6.5 points above the previous month's estimate, suggesting that employment in the services sector grew strongly in December. Now, obviously, services is the dominant sector of the US economy, so this is really important, and it kind of indicates that we may see a strong beat this time. Okay. The other key leading indicator for the jobs report was the private sector payrolls report. This came in at 174,000, well above 48,000 expected. So once again, this shows that employment increased in December more than expected, and kind of more than made up its losses from the previous month of 123,000, according to ADP. So overall, these pre-NFP leading indicators point to a strong rebound in jobs growth. And that's what the market is now expecting. Okay. Now, based on these leading indicators and what's been happening in the markets, I have come up with kind of 3 different scenarios that I will be looking out for after the jobs report is released. The first one is obviously if the NFP data comes in well above expectations. If that happens, then I would favor looking for ongoing risk-on trades, right? So currently, there's the reflation, or the so-called reflation trade, whereby everyone is expecting a strong economic rebound this year because of the vaccine rollouts and hopefully things turning back to normal. Everyone is expecting a strong rebound in the economy. That's why stock markets are going up. That's why we're seeing commodities like crude oil doing really well. Commodity dollars are performing well, and other foreign currencies as well. Yes, they have come back down a little bit of their highs in recent times, commodity dollars, but generally the trend has been bullish for those currencies. We've seen emerging market currencies like the Turkish lira rebounding really strongly as well in recent times. So currently it's risk on, right? Stocks are going up, crude oil, etc. So I would be looking for a trade on those markets on the long side if the NFP comes out well ahead of expectations. And so far as the dollar is concerned, the dollar is likely to rise sharply if jobs report comes in ahead of expectations, or well ahead of expectations, especially against haven currencies like the Japanese yen, the Swiss franc, and perhaps gold. So maybe shorting gold could be an ideal situation if the NFP comes out really strong. Now, on the flip side of that, if the NFP disappoints really badly, then looking for, yeah, my colleague just informed me that he can't make it. Sorry, guys. So it's just going to be myself presenting this. He's got some technical issues. Anyway, so the flip side of that is the NFP comes out really bad. Okay, so I'm talking about a negative number. That would really catch everyone by surprise, I think. And in that scenario, I think looking for long setups in gold and shorting the dollar against perhaps the Japanese yen or other safe haven currencies would make sense. Now, in between those numbers, if it's a slight beat or a slight miss, I think it will still be risk on, as in stocks might rise, but probably not as much as they would rise if the data comes out really strong. But in this case, if it's in between those two extremes, I would then look for bullish setups in the cable, in the pound against the dollar. Now, the pound has been a strong performer in recent days because of, well, so many reasons. Firstly, a no-deal Brexit has been avoided last year, right? So people are unwinding some of their bearish bets on the pound. On top of this, you have the UK vaccine rollout being quite a success story, actually. Here, we have had more than 10 million people vaccinated already, which is great, and hopefully means that lockdowns can end quicker than other countries, meaning that the economy is likely to rebound and do so strongly, which is why the pound has been rising sharply against other currencies. So if the NFP comes out in line or slightly ahead of expectations, then looking for the pound dollar long trade might be an ideal scenario today. Okay, we'll now transition into the live charts. And if you have any questions so far, please ask. If not, let's go to the charts now. Now, the first chart in front of you is the dollar CAD daily. The reason I'm looking at this particular currency pair, well, two reasons really. Firstly, from a macro point of view, we have Canadian employment report released at the same time as the US jobs data. So this currency pair will be really busy today. And it could literally go either direction depending on the outcome of those two jobs reports. From a technical point of view, this is what I'm looking for. Okay, so as I mentioned, the Canadian dollar and other commodity dollars have been trending upwards. So the dollar CAD has been falling since March of last year. And will that trend resume today? Well, it will need. We'll need to see a disappointing US jobs report for that to happen, for the bearish trend to resume. If we get a strong US jobs report, then there's a possibility that the dollar CAD may break through this bearish trend line. Yeah, if it does that, then there's a chance it could go all the way up to 129.50, which is a key level of potential resistance. It was a big level of support in the past, as you can see by this little arrow here and here. Once we broke through that level in December, price came up to retest that level and it sold off from there. So that's the key level of potential resistance that remains there. And so if we get a strong beat on the US front or a massive disappointment from the Canadian employment report, then this currency pair could rise to test that level. Alternatively, if the Canadian employment report comes out really strong or the US data disappoints, then we may see the resumption of this downward trend. And that's what I would be looking for, because the bearish, because the longer term trend is bearish, I like to go with the trend. And so I would be more inclined to look for short setups than long setups in this currency pair. Now, for me, the trigger could be if price were to break below 127.50, which has been a pivotal level. If you look at your intraday charts, you can see that it has provided resistance here, and then price bounced off of it, and so far it's holding above. So if you go below that, then I think that would clear the path of clear the path for a move back down to this year's earlier lows, and possibly beyond in the days ahead. So the key level on the downside that needs to break is 127.50. We'd be bearish below that level. It is also possible that the dollar CAD could break the trend line, go and test the resistance at 129.50 and forms a reversal looking candle, like a inverted hammer or a shooting star there, and then rejects, comes back down, goes back below the bearish trend. That would also be a scenario that we could look at next week or in the weeks ahead. But if it breaks decisively above 129.50, then at that point you'd have to drop your bearish bias on this market, because then price will not only have broken its bearish trend line, but it will have also created its first higher high above this high right here. Right, so that's the key level I'm looking at for. If you have any questions on this, please ask now. I'm going to move on to the pound against the dollar. Now, this market has been trending strongly since September of last year, when investors started to anticipate that a no-deal Brexit could be avoided, which happened to be the case. Yesterday, on Thursday, the Bank of England met and decided to keep interest rates unchanged. No one was surprised by that decision, but the Bank of England was bullish in its outlook for the UK economy because of the vaccine rollout program. So as a result of yesterday's price action, the cable, or the pound against the dollar, held its own above the 21-day exponential moving average, which is this red line here. And it also held inside the bullish channel. So for as long as the pound remains inside this bullish channel, the path of least resistance remains to the upside. And following yesterday's formation of a hammer-like candle, this has potentially paved the way for further gains in the days and weeks ahead. So in the event that the US jobs report disappoints, then I would favor looking for bullish setups in this market. And if you look at price action in greater detail, if you go to the hourly chart, this was the response to the Bank of England. So what I would be looking for is for price to remain above this black level here at around 136.50-ish, because this was the most recent low. And since that low was formed, price has now formed a higher low above this one. So for as long as we remain above that, the short-term bullish bias would remain intact. But if you go below that, then you'd have to be a bit more careful, because the dollar, as I said, has come back up against a number of currencies in recent times, and it could do so against the pound as well. So be careful. But at the moment, the path of least resistance looks to be to the upside. So from here, where do we go? Well, you'd have to think about in terms of where trap traders, stop loss holders would be resting. And one particular area would be these equal highs here. So some people would look at that and think that this is a double top, right? Well, it was a double top leading to a nice move down. But with price forming this key reversal now, will this level break? I think it will, if the jobs report comes out weaker than expected. Or in any case, I expect this level to give way eventually, possibly at some point next week. But as far as today is concerned, obviously a lot depends on the outcome of the US jobs report. Now, I like this level because it's equal highs, meaning that there will be lots of stops resting above it from people who think that the cable should go down, which means therefore that if price starts to edge towards this level, then you can anticipate a breakout above it, because once you break through a key level like that, you'll see an acceleration in the rally. So that's what I'm expecting to see in the cable. It's could it happen today? Who knows? Depends a lot on the jobs data, as I keep mentioning, but eventually that's what I'm expecting so far as the cable is concerned. Because if you look at the euro pound, the cable has been trending really strongly, and this is the euro pound, suggesting that relative to the euro, the pound has been gaining strength. No surprises really, because of those macro factors I mentioned. I can see a question, interesting. Dollar euro, what effect is expected from $1.9 trillion package relief? Good question. So let's go to the euro dollar. Now, the 1.9 trillion fiscal package, if it becomes law, at the moment it's just a bill that they needs to pass before it becomes law. I think it will be good news for the dollar, because it means government spending or spending in general will rise in the US, boosting the economy. So I think it will provide short-term support for the dollar. But the question is, has this already been priced in? We have seen the euro dollar come down off the highs since the turn of the year, literally since Biden won the elections. So investors have been pricing in the impact of that already in the dollar, especially against the euro. So that's the key worry for me. Is that already priced in? If it's not priced in fully, then sure, the euro dollar could go a little bit more lower from here. But from a key technical point of view and ahead of the NFP, this was the key support level that broke down yesterday at 120. So when that level broke, it also took out this bullish trend line. And now the path of least resistance looks to be to the downside once again for the euro dollar. From here, and depending on the outcome of the US jobs report, we could see price go back to retest the broken support at 120 to 120.10 area, formerly resistance and support, and we could see price turn lower from there again. But in the event the US jobs report disappoints badly, or if otherwise the euro goes back above the broken trend line, then that would be a strong bullish signal for me. In fact, that's what I'm looking for more than the bearish scenario, because if you look at this chart here, this is the monthly euro dollar chart. Yeah, the monthly chart shows the break of the long-term bearish trend. So on this time frame, sorry, it says weekly here, but it's the monthly. Now on this time frame, the trend is bullish because we've broken above this long-term trend line that had been in place literally since 2008, right? Long time ago, we've broken above that. So on the monthly, the path of least resistance is to the upside. I'd rather trade the euro long than short based on this chart. More to the point, in 2017, the euro dollar staged a rally. It then consolidated for a while, and then it broke further higher. In 2020, it staged a rally, consolidated for a while, and then it broke higher. But is the buying done? I kind of don't think it's done. I think it's got a little bit more juice left. Obviously, the euro area has had trouble rolling out the vaccines. There's been delays and so on, and that's caused a bit of uncertainty about the eurozone economy, because it means lockdowns lockdown measures or whatever can remain in place a bit longer than would have been the case. But with the ongoing risk-on trade and reflation trade, I think the euro dollar is still headed higher long term. So watch out for a potential bear trap sign to form around that 120 handle. Key support, key level this is. So a temporary break above or below it is not going to make a material difference in the long, in the grand scheme of things. Which is why, going back to the daily, you need to be very careful trading that level, because if you see signs that the sellers are trapped there below that trend line, that could lead to a significant rally. Now, to show you exactly what I mean, consider this. Imagine that price never, you haven't seen what happened in the future. Look at price action here. Sorry. So if I draw a trend line connecting this low with this low and this low, yeah. Now, if someone saw that when price broke below that trend line, they'd be like, wow, the market has stopped. It's broken the trend line. It's making lower lows, lower highs. And then it goes down for a few days, and then boom, all of a sudden it creates a higher high above this high. And then it goes down a bit before staging another rally, and then eventually broke out. So what I'm saying is, what happened here with that trend break is something that I am expecting to happen again around here somewhere. So if the euro dollar goes back above this broken trend line, I would be very bullish on the euro dollar. So, for now, it looks like it wants to head a little bit lower, and that may be the case. I could be reading this completely wrong, but if it does that, if it goes back above the broken trend line, then I'll be looking for bullish setups on the euro dollar. So be careful how you trade around the 120 handle if you do trade it short today. Don't get caught in a move like this. That's what I'm trying to get to. Guys, any more questions before we move on? Let's look at the dollar yen. Now, the dollar yen has been one of the strongest dollar pairs in the dollar's recovery since the turn of the year. It has been rising for 1, 2, 3, 4, 5, 6, 7, 8 days now. What do you think the RSI will be telling us? The momentum indicator, if we add it. Yes. Overbought. Right? No surprises there, because price has been going up sharply in very quick time. So be careful with the dollar yen if you're still bullish on this market. And the dollar yen has also reached a possible resistance area here. Around 105.70, where it had previously struggled. Here we also price is also testing the 200-day moving average. So there is a possibility we could see the dollar go down from here. But as I keep mentioning, if we get a massive beat today on the jobs front, then the dollar CAD could break 105.70. Gold has sold off yesterday really sharply. Previously, it was finding good support around the 200-day moving average, as you can see here, and here. But this week, it's kind of broken and held below the 200-day moving average, creating lower highs in the process as well. So gold is not looking really great at the moment. And if you're bullish on gold, although it's testing this long-term support at 1800, which is this level here, as you can see on the monthly time frame, this level here, previously resistance broke above it, turned into support once, it's testing it again. If you're bullish on gold, I think waiting for a trigger would now make sense. So the way I would play gold is I'll wait for the market to tell me that it has formed a low before looking for long setups. So specifically, I would be looking for price to now go above the most recent high that was made prior to this latest breakdown. Now, the most recent high was made at 1875. So if it goes back above that level, if it goes above 1875, then at that point, I would turn bullish on gold again. Right now, I'm kind of in two minds, really, because on the one hand, it's broken down. It's looking quite bearish. But on the other hand, it's testing that long-term support around 1800, which is important in terms of the longer-term outlook. So obviously, it could bounce from here. If it does bounce from here, the next potential level of resistance is this level right here. We just color that in red. 1830-ish. 1830 is where, if you're bearish on gold, you could be looking for possible, bearish setups around that level. Actually, I mentioned 1875 as being the bullish trigger for me. Let me duplicate this and bring it down to above Thursday's high, this level here. Think about this. On Thursday, we created this thrust candle here that led to the breakdown below this low here. Now, there's no reason for price to go back above this level, as this is still bearish, right? So if it does go above that level, that would provide us the first indication that the sellers got trapped here and that price wants to push higher. So that would be my first signal to look for long setups again if we go above Thursday's high. The key turning point would obviously come when if and when price makes a higher high above this high, but that would be my first bullish signal. Does that make sense? Come on, guys. I need more questions. I've got like 5 minutes to spare, and then we'll end the webinar. If you've got any questions about any markets that we provide at Think Markets, I'd be more than happy to answer. Let's talk about indices while I wait for your questions. Now, if you look at, I don't know, S&P futures right here, the market is expected to open at fresh record highs today. This is the daily chart. We broke above the previous all-time high at at 3,870. We broke above it yesterday, and we are so far holding above. So from here, it looks like the path of least resistance is obviously to the upside, and the 127 extension of the last downswing comes in at 3,926. That could be the next bullish objective. But if you go below the shaded region, then that could be the first kind of bearish indication that could lead to a drop to 3,785, which is the next level of support on the daily time frame. With the index being above the 21-day exponential and the long-term trend line, I'm not even exercising the idea of bearish setups on the indices, on any indices, not just the S&P. But if in the future we create a lower low, so in this case, if you go below this low here, at that point, things will turn bearish. We will cross that bridge if and when we get there. Cryptocurrencies. You know what? I'll make an exception. I'll very briefly touch on cryptos, but in these webinars we don't typically cover crypto. So Ethereum is looking quite bullish, as do all the other cryptos. It has broken above the 2018 high at 1595-ish. So that's the key level that it needs to hold above. And so far, it's doing a good job at that. From here, where do we go? Well, let me go to the longer term chart. So when the market breaks to record highs like this, there's no way, there's no prior reference points for you to use to determine where price is likely to head to. Now, one of the tools that you could use to have some kind of objective targets would be Fibonacci extensions. And if you draw your Fibonacci extensions from this high to the most significant low and delete all the retracements, you have the Fibonacci extension levels there. So the next key target, insofar as Fibonacci extension, doesn't necessarily mean it will get there, obviously, but if it does get there, that would be an objective area for some people to take profit around. So that level comes in at 2006. Call it 2000. That's the next big level for Ethereum. On the downside, going back to the daily, if the black level breaks and we hold below it, then the next key support is this level here at 1830, at 1380-ish, 81. Why that level is because that's where Ethereum broke out from its consolidation pattern, right? Guys, I have run out of time. Before I end this webinar, let me remind you that we have live analysis webinars, like how I've analyzed the market for you guys just now. If you like that kind of stuff, please make sure to join me in the live analysis webinars. If you go to the website, depending on your region, let's just use international. So today was the NFP webinar. You have live market analysis on Tuesday, same time at 11:30. And I have this webinar every week, right? So next one is on 16th and so on. Make sure you register for those. And I will be more than happy to provide you analysis on any particular market you're after in those webinars. But insofar as today's webinar is concerned, it was about the jobs report. And I hope I have provided you some useful information that you can take away and use for your trading when or after the jobs report is released. Have a wonderful weekend, everyone. Thank you so much for joining me. And I hope to see you on Tuesday. Take care now. Bye-bye.